IXUS won the sprint with 35% in 1 year, but VO's playing the long game at 55% over 5 years. Let's dig into the details. IXUS just crushed it with a 35% return this year. That's the kind of performance that turns heads and opens wallets. But here's where it gets interesting. VO's 13% return looks solid until you realize the other fund we're comparing it to absolutely crushed that number. In plain English, here's short-term performance in race car terms. IXUS blew past the competition nearly 3 times faster this year. Same track, but one car clearly had the better engine under the hood. Now let's shift gears and look at VO's 55% return over 5 years. Proves that staying invested through the ups and downs really does pay off. Here's where the story takes a turn. IXUS delivered 48% over 5 years, but VO overtook it. International stocks couldn't keep pace with US mid-caps. Let's break this down further. VO's 55% crushes IXUS's 48% over 5 years, a 7-point gap that shows why patience pays off in investing. In plain English, think marathon runner here. VO's steady consistency beat IXUS's flashy start. Slow and steady wins the race when you're investing for the long haul, not quick sprints. Here's where things get revealing. Raw returns look impressive until you ask, what kind of wild ride did you endure to get there? Now let's put this in perspective. VO's Sharpe ratio of 0.4 means you're getting solid returns for every unit of risk you're actually taking on here. But wait, there's more to this story. IXUS's Sharpe ratio of 0.3 means you're not getting much return for the risk you're taking on here. In plain English, the Sharpe ratio is basically your investment's report card. It measures how much return you're getting per unit of risk taken. VO earned better grades for less effort, while IXUS struggled despite working harder. Let's take a closer look. A Sortino ratio of 2.3 means IXUS cushioned the downside beautifully. You're earning solid returns without the brutal drops. Now here's where it gets tricky. VO's Sortino ratio of just 0.8 shows weaker downside protection. IXUS managed bad days much better over the past year. But that's not the whole picture. IXUS's 2.3 Sortino crushes VO's 0.8, meaning when markets tanked, IXUS protected you way better than VO could manage. In plain English, the Sortino ratio measures downside risk. Basically, how much your investment wobbles when things go south. IXUS kept its balance this year like a steady seesaw, while VO tipped more dramatically. Here's what really matters. Maximum drawdown reveals your worst-case scenario, the gut-wrenching moment when your portfolio hits rock bottom and tests your resolve. Now let's connect the dots. A 30% crash means watching almost a third of your savings vanish. That's the harsh reality of IXUS's worst moment. But hold on a second. VO's 28% maximum drawdown shows it wasn't much safer. Just 2 percentage points separated these funds during the crash. In plain English, maximum drawdown shows us the storm. Both funds took a beating, but IXUS dropped slightly harder before climbing back. When markets crash, neither will save you completely. All right, who's your pick? IXUS or VO? Drop your vote in the comments now. Now let's flip the script. Recovery days tell you how long you'll be waiting to get back to even after a market crash hits. But there's a catch. IXUS took 581 days to recover from its worst drop. That's over 18 months of just waiting to break even again. Let's get into the weeds here. VO needed 641 days to recover. That's 60 more days than IXUS, showing slower bounce back from major losses. In plain English, recovery time matters like building collapse. Both funds needed nearly 2 years to rebuild from rubble. VO's structure took an extra 2 months to restore to its former height. Here's where it gets interesting. Volatility is basically your financial heartbeat. The bigger the swings, the wilder the ride your portfolio is taking daily. Let's dig into the details. VO's 18% volatility means you're in for a wild ride. Expect your portfolio to swing hard on any given day. But here's where the story takes a turn. IXUS runs calmer than VO. 16% volatility means you're getting 2 percentage points less turbulence over 5 years here. In plain English, think of volatility like a roller coaster ride. VO's got slightly wilder swings with taller drops and climbs, while IXUS offers a smoother journey but still delivers plenty of thrills along the way. Beta and correlation show you how tied your fund is to the market's ups and downs. Independence matters here. Here's where things get revealing. IXUS moves less than the US market with a beta of 0.8, giving you genuine geographic diversification when markets swing. Now let's put this in perspective. VO's beta of 1.0 means it mirrors the S&P 500's moves. When the market zigs, VO zigs right alongside it. But wait, there's more to this story. IXUS's 0.8 beta means it won't crash as hard when US stocks tank. VO's perfect 1.0 offers zero protection whatsoever. In plain English, beta is all about dance partners. VO follows the S&P 500's every step. They're perfectly in sync. IXUS, it's doing its own thing, moving to a completely different rhythm. Let's take a closer look. That 0.8 correlation means IXUS moves somewhat independently from US markets, offering you genuine diversification when you need it most. So what's the verdict? IXUS grabbed the short sprint with 35%, but VO dominated the long game at 55%. VO wins on risk-adjusted returns, while IXUS offers better diversification and downside protection. But that's not the whole picture. VO moves almost perfectly with the S&P at 0.9 correlation, so you're basically getting US stocks with a different wrapper here. In plain English, think of correlation like a seesaw. When the S&P drops, VO's almost guaranteed to follow suit. But IXUS, it's got way more independence, moving to its own international rhythm. Here's what really matters. Here's why every basis point in expense ratios matters. Those tiny fees compound relentlessly, creating massive wealth differences over decades. Now let's connect the dots. At just 0.04% annually, VO's expense ratio is incredibly low. You're keeping nearly every dollar of your returns. But hold on a second. IXUS charges 0.07% annually. Still incredibly cheap, but nearly double what VO costs for its international exposure. In plain English, 4 pennies versus 7 doesn't sound like much, but over decades that difference compounds into serious money. It's classic couch change. You barely notice it until you add it all up years later. Here's the key takeaway. Dividend yield tells you how much cash you're actually pocketing from your investment. Higher yields mean more money flowing in. Now let's flip the script. IXUS delivers a solid 3.2% dividend yield. That's real income landing in your account every year while you hold it. But there's a catch. VO's 1.5% dividend yield looks underwhelming when IXUS delivers double that income, a significant gap for income-focused investors to consider. In plain English, think of it like your tax refund. IXUS delivers double the cash compared to VO each year. Growth investors won't care much, but if you're counting on income, that difference matters. Here's where it gets interesting. Lower PE ratios mean you're getting more bang for your buck. paying less for each dollar the company earns. Here's where it gets interesting. At 14.6 times earnings, IXUS offers a nice discount compared to pricier U.S. stocks. International markets trading cheaper here. Let's dig into the details. VO's 18.5 PE ratio isn't cheap. You're paying a premium for U.S. mid-cap growth exposure here. In plain English, think of it like your investment report card. IXUS scores $15 per dollar of profit. VO scores 19. Lower doesn't mean better grades, just cheaper tuition for similar classes. Let's break this down further. Where your fund puts its money matters, heavy on banks and insurance or spread elsewhere, it shapes your returns. Let's dig into the details. IXUS puts nearly a quarter of your money into banks and insurance. That's a massive bet on financial services here. Here's where things get revealing. VO keeps just 14% in financial services. That's smart diversification, spreading risk across way more industries than most funds. In plain English, here's how the pizza gets sliced. IXUS loads up nearly a quarter of its portfolio in financials, while VO spreads things out more evenly across sectors. But wait, there's more to this story. VO's laser-focused on mid-caps. 91% of your money goes straight into medium-sized companies, no diversions into large or small-cap territory. Here's the thing, though. IXUS keeps it simple. Just 17% in mid-caps, putting most of your money into large international companies instead. In plain English, here's the key difference in mid-cap allocation. VO's betting almost entirely on medium-sized businesses, while IXUS sticks with big, established players. Think of it like choosing which basket holds your eggs. Now here's where it gets tricky. IXUS spreads your money across over 4,000 companies worldwide. That's about as diversified as international investing gets. But that's not the whole picture. VO keeps it tight with just 295 holdings, way more focused than IXUS's broader approach to international investing. In plain English, here's the egg basket lesson. IXUS spreads your money across thousands of companies while VO sticks to just a few hundred. More diversification means one company's bad day won't wreck your portfolio. So there's your answer. VO if you're chasing US growth long-term, IXUS if you want global diversification and steady income. Now let's connect the dots. Here's your selection guide. VO targets growth in US mid-caps, while IXUS delivers income through international diversification over similar timeframes. In plain English, here's your road trip analogy. VO's the US interstate promising faster growth, while IXUS takes international routes offering broader diversification and steadier dividend income. Choose the journey matching your investment destination. Let's unpack this a bit. Before you invest, do your homework and talk to qualified professionals first. Here's the key takeaway. Thanks for watching. Hit that subscribe button if you want more deep dives like this delivered weekly.